The DAX is up about 12% just in the last 6 weeks alone. Do you expect this performance to continue into 2024?
Oh yeah, we're pretty positive on 2024. We do think that this outperformance of the DAX that we've recently seen, that's coming to an end. So index targets for DAX and the other European indices are quite similar. So we think that will probably come to an end, but we are generally quite positive on next year. A bit more cautious actually on the short term, because if you look at volatility nowadays, it's at the level that we've last seen in January 2020. So 4-year low in a week where we have so many macro events, right? You mentioned the dot plot today. I think that will be a negative surprise for market. So, last 4 times we've seen the dot plot, markets were negatively surprised because we expect the dot plot to again only show 50 to 100 basis point cuts for next year, while we think it's going to be more, and the market is also pricing in more. So very short term, we're a bit more cautious. Long term, as I just said, I think we're going to see more cuts. We are thinking of 175 for the Fed, 150 for the ECB. That's more than the market is currently pricing in. So that should be supportive. Also, of course, for the DAX. The DAX is still trading at 12 PE. We think that's too cheap. So European equities in general should have more upside on the multiple front from those lower rates. And also on earnings, same for DAX as for the other indices in Europe. Consensus only expects 2% earnings growth for next year, which is quite benign, and we think it could easily be 5%, which is still quite conservative, I would say. And mixing those two together, so slightly higher multiples, slightly higher earnings, we see 8% upside for the DAX and for the rest of Europe for next year, which is quite a bit higher than peers again for next year.
Well, thank you. Thank you for that overview. One other thing that struck me from your 2024 outlook is you do think that European equities are going to outperform their U.S. counterparts. It's a bit of a bold statement given how well the Magnificent Seven have done this year.
Yeah, it's early days, I would say, but it's just starting to work out. So 3 weeks ago we called for an overweight in Europe. It's more of a tactical view. We think that's going to work out better in the first half of the year than in the second one, and basically 3 reasons. Number one is the absolute level of growth in Europe might be lower than in the US, but if you look at surprise indices, they're actually picking up in Europe and they're coming down in the US. So the direction of travel, when you look at economic data, for example, disinflation, is actually more interesting in Europe right now than it is in the US. Number two is that, we've seen the strong directional move in markets, and we now think that investors will start to look for relative value trades. And Europe was much hated this year in equity terms. And we think, with growing trust in the market, there will be more investor interest into Europe. And right now, it's trading at an all-time multiple discount to the US of 6.5, right? So very, very big discount. And we think one of these relative value trades where you can make money in the first half of the year, and probably second half of the year, things will level out again, and we get similar targets for the US and for Europe.